NXP Semiconductors believed to be one of the best AI stocks for 2024, but is it undervalued? Is it a buy now? Let's find out in today's episode. As usual, we'll run through the historical performance of the company. We'll look at their revenue top line growth as well as their bottom line net income growth. We'll have a quick health check of the company, their total cash versus their total debt. We'll also see how well they've performed, not just over the last few years, but also versus some of their competitors in the industry. We'll talk about some insider selling that we have seen over the last few months. We'll touch upon their dividend safety. We'll look at dividend yield theory, some strong financial metrics, and we'll see what the institutions have been doing quarter on quarter in 2023. And they did recently report their earnings, so we will briefly touch upon that. And as always, the most important thing, the valuation. We'll run through the intrinsic value, get to our acceptable buy price given our investor margin of safety, and we'll look towards Wall Street to see what price they forecast over the next 12 months. So let's start off with their latest earnings. Now we'll just touch upon this very quickly. So they delivered their fourth quarter 2023 non-GAAP earnings, $371. Now this was a beat from analyst estimates by around 1.92%, although when you compare it to year on year, it was down slightly 0.5%. However, their revenue, not only at $3.42 billion did it beat analyst estimates of $3.395, but it was also up 3% from a year ago. So we see both top line and EPS beating analyst estimates, although we do note that their essential EPS did miss slightly on a year-on-year comparison. Now, in terms of the performance of this semiconductor, they are up 19% over the last year. Over the last 10 years, very strong, up 300%. Bear in mind, it doesn't include those dividends reinvested, so very strong nonetheless. And we can see they are in the mid to upper end of the 52-week range. They do have a yield just under 2% and forward P sitting around 16. So let's do a deep dive of their top line and bottom line. 9.4 billion reported in 2018. As always, for the top line, we are looking for around 3 to 7% growth year on year. December 22, 13.2 billion. So we do see an increase from the last 5 years. December 23, around 13.2 billion as well, as we mentioned. So we can see their top line from the last year has dropped very slightly, but over the last 10 years, in fact, over the last 5 years, they have increased their top line. But we do know the inconsistencies. 2018 down to 2020, their top line did drop before increasing into 2022 and then expecting to be fairly flat into 2023. And their bottom line, 2.2 billion reported in 2018, 2.8 billion reported in 2022 and 2.8 billion expected in 2023. So yes, their bottom line has increased over the last 5 years. We do note though from 22 to 23 it is expected to be flat. So on a more granular level on the bottom line, it did go from 2.2 billion all the way down to 52 million in 2020. Although it did pick up back strongly again. So both top line and bottom line, while they have increased, we do note that there are a lot of inconsistencies year on year. And we will touch upon the last 10 years percentage-wise shortly too. Cash versus debt, quick health check, 2.8 billion in 2018, 4 billion in their latest quarterly report. So they are holding more cash than they did 5 years ago. In comparison to their total debt, what we do see here, 7.3 billion total debt in 2018, 11.2 billion in their latest quarterly report. So we note their total debt has in fact increased significantly more than their cash. But we'll look very briefly at their net debt to EBITDA metrics shortly as well to take a look at their dividend safety and balance sheet strength. Now, a quick look at the semiconductor industry as a whole. A few well-known competitors, Marvell Technology, Infineon Technologies, and a few others. Over the last year, we see NXPI up 21%. In fact, we do note that some of the semiconductors have returned negative, so they have performed fairly well, the second best in the industry over the last year. When we extend that to the last year, we see them up 160%. This does include those dividends reinvested. In the midpoint of their industry, we see Marvell Technology up significantly more at 263%. Nonetheless, fairly positive, but always remember past performance is never an indicator for future performance. Quick look at insider buys, insider sales. Now we do note that the CFO as well as the CEO have sold shares over the last month in December, in fact. Although what is interesting is that they have sold at a lower price. As we can see here, the share price has gone up since they sold. And what's important to note from what I always say, insider selling isn't a bearish signal. Insiders sell for many reasons, and that is whether that is personal or financial reasons. But as always, to be transparent, we do like to look at the insider selling as well as insider buying. In terms of institutional ownership, it sits at 90%. 3.3 billion, in fact, worth of sales by these institutions over the last 12 months. Around double buying 6 billion or just under in the same period. So the institutions do quite like NXP Semiconductors, and we do know in the more recent quarter, Q4, institutions have been buying more shares than selling. As always, do bear in mind, do your own due diligence, never go off what the institutions are doing. In terms of dividend safety score, we see a 60 borderline safe score. Market cap 58 billion. It is a large cap company. In terms of the recessionary metrics, well, they didn't pay a dividend in the last recession, but they had below average growth, negative 40% versus the S&P's negative 12%. They also had a very large double-digit increase to the dividend in January 23, 20%. We love to see that, very, very strong. And we also note they have been increasing those dividends for just the last 4 years. In terms of dividend yield theory, well, it states a company is undervalued when that current yield sits above the 5-year average. So we have a sign here, 1.84 versus 1.32. Bear in mind, we're not looking at any of these in isolation. 5-year average then, 15.9 forward PE versus 14.6. And when we compare it to the information technology sector PE at 26.7, NXP is significantly lower. Now, they've only been paying a dividend for the last few years, so in 2018, we can see the free cash flow payout at 4%. Now, as always, I do ignore the earnings. It is susceptible to manipulation by management through accounting. My preference, below 60% on the free cash flow. If you want to be industry specific for semiconductors, you can bring it to 50%. What's positive to see that it hasn't even been above 50% in 2023, the latest year at 42%. 2024 expected to go lower, so I wouldn't be surprised if we continue to see strong double-digit dividend increases from NXP. Very nice to note, the free cash flow per share has pretty much doubled over the last 10 years, 464 to 970. Granted, it hasn't been consistent, but in more positive news, in 2024, it is expected to go even higher at $12. When we look at the sales growth, pretty inconsistent. We do want to see 3 to 7% for steady moderate growth. We do note in the more recent period, though, only a 1% increase to the top line. Numerically speaking, then, we can see their top line has more than doubled, 5.65 billion to 13.3. Shares outstanding. Now, personally, we love to see it when companies do share buybacks, returning excess cash to investor pockets. They've done both share buybacks. They've also issued shares to dilute your position. Overall, over the last 10 years, though, your position would have been diluted. They did add, as we can see, around 12 million worth of shares. Not massive in relation to the total amount. ROIC, as always, I want to see 10% or more. It gives me faith that management are able to effectively allocate their capital. So it is nice to see the last 3 years, strong double digits to the return on invested capital metric. They did go through a long period where it was very low. So if this continues, then this could be very strong moving forwards. And it does right now give me faith in terms of management and their ability. Operating margin, very strong over the last 3 years. Probably something just to keep an eye on, given how for 5-year period of the last 10 years, it did dip significantly below 16%. Free cash flow margin, beautiful to see, consistent year on year, pretty much 19 to 20% every single year, well above the minimum 5%. Now, remember the net debt to earnings before interest, tax, depreciation, amortization shows us the dividend safety and balance sheet strength. We want to see below 1.5. Number of years that it would take the company to pay off all of their debt net of cash on hand. In 2023, we see this as 1.28. It is expected to increase in 2024 to 1.42, still below the maximum we like to see, but something moving forwards just to keep an eye on. Let's jump into the valuation then. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, given this is a fast-growing company, we have excluded Graham's valuation, although we do want to note that in 2023, their top line wasn't as strong as it usually is. So this could be one that you could bring in. It is subjective. For today's episode, we're going to start off with the multiples valuation. We have companies in a similar sector and size that we ran through, the average P multiplied by the earnings per share of NXPI to get $190. Now, this is our first signal over valuation, but again, bear in mind we're not looking at any of these models in isolation. They have been increasing those dividends over the last 4 years, very strong double digits, on average around 42-43%. Forward looking, we've been conservative, 6.5%. This comes to $288. We have our first signal of undervaluation. We then move on to the DCF model with the free cash flow year on year. Average growth rate 26.5%. Forward looking, we've gone more conservative, in fact, than both the analysts and the average. In conjunction with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get there a second signal of undervaluation. So the intrinsic value for today's episode of NXP Semiconductors comes to a total of $253. Now, as always, we use a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, and good forward-looking data. And don't forget, you can grab a copy of this valuation model to get to both the intrinsic value and acceptable buy price of companies in your own portfolio by clicking on the pinned comment below. So a 10% margin of safety for NXP comes around $228. At 15%, around $214. So right now, at the current trading price, we see between 10 to 15% as a margin of safety. In terms of Wall Street and what they forecast over the next 12 months, well, they have a price target of $260. They see upside of 18%, so they do believe this is a strong buy. It has been on a strong run, and they do see this continuing. And we did see the semiconductor industry as a whole, given this AI bubble, does continue to move forwards and upwards. As always, though, do let me know your thoughts in the comments below. Do you like this semiconductor? Do you prefer the likes of ASML, Broadcom, or even QCOM that we did recently review on the channel? As always, if you enjoy the content, smash that like button. I'll see you all on the next episode, and for now, take care.